Can you imagine learning how to own a skyscraper? Not just one, but a ton of them. Today, we're talking to Tom, the skyscraper guy. He's going to show you exactly how he did it. So let's get started. Hey guys, welcome. Today we are talking to Tom, the skyscraper guy, and I think you're in for a treat. So Tom, welcome to the show.
Thank you for having me.
Man, to start off, I have to say you blew up on Instagram, right? Under Skyscraper Guy. If you haven't followed him, make sure you go connect with him on Instagram. So I guess this is interesting how we kind of met. But when the first time we met, he's like, Andrew, anybody can own these things, man. And so we happened to be in one of your skyscrapers on the 32nd floor. So when we think about a skyscraper like this one that we're in, right, most of the times we think about an office building. Right now, you're buying this. Now what? What's the highest and best use according to you?
Sure. So they were office buildings, as most of these skyscrapers were. And in real estate, we make most of our money by repurposing, re-entitlement. And in this scenario, it's to be apartments, renovated into apartments. This building specifically is going to be hundreds of apartments, right? So that renovation time, you have to remember, infrastructure is here in a lot of ways already. And some people would think, oh, that's like a 10-year project. It's really not. It's actually between probably like a 3 and 4 year project at most, including pre-development time. It doesn't take very long. Right?
So you're actually buying an asset well below the replacement cost of it. Now you're putting some money into it. I mean, think about it like a house rehab, right? Where you're buying something that's worth $500,000. All fixed up. You're buying it for 200, putting 100 into it, boom, increasing the value to $500,000. I mean, that's a very simplistic example, but
that's right.
Effectively, that's exactly what you're doing. Just happens to be with a skyscraper.
Yeah, just multiplying it by hundreds.
Yeah, hundreds, right?
Yeah, and you benefit from the economies of scale.
Absolutely.
When it comes to this, and cost of product and all that.
So let's kind of take you back. So how does somebody get into where you are today? Where did the journey start?
Sure. So that's a really complicated question.
Sure.
I'm going to try and narrow it down.
Right.
Okay. Because a lot of times it comes down to obviously cash, understanding like whereas most people look at skyscrapers and then it's double-digit numbers in their head just on the downstroke.
Sure.
It's triple digits in their mind for the value.
Value, right.
Okay. So most people off-put it because of that.
Correct.
I would say don't. Because it is really a matter of certain deals talk to certain types of investors.
Got it.
And it's kind of the idea of, hey, if you're doing like 10 units or 20 units, you're talking to investors that are really going to float in that area, that are looking for that kind of tolerance and they feel comfortable with that. And then when you jump up to 100 units and so on, same thing. You get to different types of investors. So in terms of getting into this space, it's one, narrowing down kind of discovering like a deal enough to share with the people. And then it's the understanding of how to move money around in terms of the vehicles that you put them into and being comfortable with working with that kind of money, which is, let's say, tens of millions and upwards of hundreds of millions. And once you get comfortable with that, which it doesn't necessarily need to come from real estate, because I didn't start in real estate. I started in hedge fund space.
So that's what I was going to ask you was that how did it transition, right? You're a hedge fund manager. You're working for some XYZ company at the time, obviously, right? And then how did it translate to real estate?
Okay. So as a hedge fund manager, I actually started it in a sunroom with my brother-in-law.
So it was your own hedge fund?
It was my own hedge fund.
Wow, okay.
Yeah. So I had started a different venture.
Okay.
It was a magazine.
Okay.
And that failed miserably. 2008 was around the corner and nobody was spending any money. Okay. And so once that failed, I ended up moving in with my brother-in-law and we started this hedge fund.
Got it. So was there like some sort of a did it come in the family that somebody had run hedge funds, somebody was in that financial space? How did you guys, did you go to school for it? Meaning, were you in college? Where was the exposure from?
The exposure was from opportunity. My family didn't do it. Nobody did it. What happened was I was sitting there in the sunroom of my brother-in-law's house because I lived upstairs, just being a bum, an actual bum, just sitting there eating their cereal. And so I asked them one day, I said, "Hey, uh, Quinn, how are you paying rent? You know, how are you doing it?" And he was telling me that I took 10 grand off a credit card and I was trading in the market.
Okay.
And so from there, he was like, "Yeah, I'm doing 4 grand a month off of this." And I go, "There's no way that you're doing that." I watched him. I kept sitting there watching him, and I thought, this can't be this easy. And as I did it, I realized, oh, it's actually this easy. This was back when this is equivalent to saying back you're trading Bitcoin when it was in double digits, like $17 a like a
Bitcoin,
coin,
right? Sure.
right? That's the equivalent of what I was doing back then.
So, because whenever I think about a hedge fund manager,
Yeah.
I don't think about somebody that looks like you, right?
Yeah, sure.
I generally, right, you think about a white guy with gray hair, right?
Sure.
That's kind of the image that comes to our mind generally, right? And that's at least the pictures we see,
Yeah.
we used to see in Forbes and Fortune and all that kind of stuff, right? So at the time initially, whenever you said, okay, I'm going to basically start a hedge fund,
Yeah.
right? Was there this factor like, are you out of your mind? Was there this self-doubt? Was there other people that doubted you? Says, man, Tom, you've really lost it, right?
Yeah, well, not okay. So this particular one was gradual.
Sure.
Okay. So we kept growing and growing and making return. And I realized, oh, I need more money to make more money. Money makes money.
Sure, absolutely.
And so over time, what ended up happening is, um, eh, eh, I don't know how far you want me to go into the
Right.
story of the breakdown, but essentially, people said, "Hey, I want you to trade what you're doing."
Manage money, basically.
Yeah, manage money.
Sure.
And that's what really stemmed it. From there, I learned the process of accepting money.
Right.
Okay. What license you need, what kind of forms you need, how you need to register yourself. That is a huge part of running money.
Right.
Is understanding how to get people into an investment. And the more sophisticated it is, the more you understand that this type of investment yields this type of tax benefit, yields this type of return on paper, everything is kosher. The way they normally would see a deal, you end up getting sophisticated investors that will be more comfortable giving more money because you're talking their language and you're talking legally their language.
So part of that was going to be my next follow-up question, which was there's a language to money, right? And each sector that you invest in, whether it's real estate, big, small, doesn't matter. And you have to be able to understand the lingo.
Yeah.
You have to be able to understand the people, their appetite for risk. Was that kind of you learned as you went along?
Yes, in a lot of ways, yes.
Okay.
There was a group that did take me under their wing as the fund was growing.
Sure.
And it was in Miami, which is why I ended up moving to Miami back in the day. And there, they were able to teach me the financial lingo. And that was a huge catalyst. I would have never learned it without them. Just the way they speak, the way you say things to an institution.
Sure.
They need to, you know, what's funny is once you speak their language, the whole thing changes. Now you're just hanging out.
Right.
Now you're talking normal.
Right.
But they need to filter you
Right.
to make sure like that you're speaking on their level.
Do you pass their filters, basically? I mean,
Exactly.
it's no different than, I mean, same thing with the family office or anybody that you're dealing with, that you're at a certain level. Now they're like, okay, we're talking as buddies.
Yes.
We're not, we're not talking to somebody that we have to make them understand.
Yes.
Because they're not going to come down to your level. You have to level up to where they already are and take them to the next level.
Exactly. That's the whole. That's why I always tell people it's so important that you know these terms and when to use them, and acronyms. You know, doctors use acronyms all the time. It's no different than any other big industry.
So you're in kind of basically the space of running money. That's really what it is, which is, hey, give me the highest return and show me the lowest amount of risk for the return that you produce. Why did you move into the real estate space? I mean, obviously, skyscrapers is, we'll get into that, but what was the reason for that transition?
Yeah. So our first fund had grown pretty substantial, you know, in trading into the billions.
Sure.
And then there was a new regulation that came out that affected that fund and how it performed. And so we couldn't make money anymore. And my job is to make money. And so I had to decide, okay, what shift and how we're doing this and so on. And through running big dollars for different people and then understanding, well, where's the rest of your money kind of scenario, they all, like 90% of them said it's in real estate. So at that point, you need to start paying attention because I'm just trading their fund money.
Right.
Where's their real money?
Right.
So now you start researching that. At that point, you just say, teach me everything you know. And that's exactly what happened. They started teaching me. I started underwriting billions of dollars. Once I realized and understood and was comfortable, I knew exactly what I needed to do to find yield. That was not as strong as what you can get in the trading space,
Sure.
but more more steady, more comfortable, less stress, and it moves so much at a predictable pace, which is really what real estate investors are looking at and underwriting is the predictability, the stability of that. And so once I realized that, now I knew what I need to go look for, what kind of target returns I had to get, how much I needed to buy something for. And so that is what led it into the real estate space.
So when we think about markets, right, especially now there's a lot of different places people have put money, right? Whether it be self-storage, whether if it's be big funds we've all heard of buying hundreds of thousands of single families, right? Whether it be going into multifamilies, right? Today we're fascinated because of you, because of skyscrapers,
Sure.
right? How did you first figure out? You're like, man, Andrew, now it's obvious, right?
Yeah.
I got in the space early, you're excited about it, you're jazzed about it. But how did you first figure out that, man, play maybe to go to a secondary city, not New York, but something like Chicago, and look at buildings like the one we're in, where, I mean, there's 70% vacancy, even in this part of the loop, as you explained. And I was asking you, man, what about the absorption rate, right? What is kind of and you're like, what absorption rate? Anything I put up, it gets absorbed. But how did you get to this point?
Yeah. So to answer the first, can you say the first part of the question?
The first part of it was how specifically, out of the million things you could do in real estate, how did you pick skyscrapers?
Got it. Okay. So there's something important to know about hedge fund managers. Hedge fund managers focus on leverage. Everything they do is based on leverage. Best leverage, best debt in this scenario. When you break down each segment of real estate, multifamily is really at the top, and that is because the leverage is the best. All right. There was points where you can get up to 95% LTV. Okay. Now CMBS is getting us up there back to the 80, 85. That is key in differentiation between a self-storage, commercial lease, and so on. Even hospitality, you're 65% at best. If you're very good with the lenders, you can maybe get to 70, but you're 65 typically underwriting. Okay. So on that basis, less money to go further. That's what led to specifically multifamily. Now, in terms of skyscrapers, this is a completely different segment in itself because there's not many for sale.
Correct.
All right. So we talk about here, Chicago, there's only 128. There's really not that many. And the ones that are for sale, those are the ones that it's all within the circle. They just, like this building now, is because they knew we bought another one and another one. So they just know we can take them down.
So first question is, what qualifies for the title skyscraper?
It's 300 feet, 150 meters.
150 meters. Okay. So that's kind of the definition where you officially become a skyscraper.
Yeah.
Okay.
Yeah.
So did you start with smaller multifamilies and then graduate here?
Not necessarily. Most people would think what I did was not small.
Sure.
Because when I was underwriting for the family offices, all of their units were the hundreds of units per buy.
Got it.
And they were always complexes. There weren't single family things. And the reason for that one is the leverage.
Sure.
It's changed a little bit now, and it's something called BTR, and I'll kind of explain that. But it was a threshold, a mathematical kind of equation, which is if I'm going to be doing deals, I want to be able to be cutting checks to myself for over 100 grand just to do my normal job and no matter what. And that number was about 100 units.
Got it.
Okay. After all expenses, you pay all of the supers and admins, your take homes, around 100, depending on what you're paying your investors. So on that basis, the first deals were 100 plus units.
Sure.
And I just went straight into that. But that's because I knew exactly what I needed to do, who I needed to talk to, and I had the backing for the loans to get those things done.
So basically, in that, is it a structure where you have GPs and LPs, and you knew enough group of GPs where you could come up with the downstroke from the limited partners, so you guys could execute that deal?
Exactly.
Okay.
Yeah, you're syndicating.
You're syndicating.
Yeah. So when people, I say I'm the face of the deal,
Sure.
so I can say, yeah, I bought the skyscraper.
Sure.
But ultimately, it's like my investors bought. Like it's
Absolutely.
all because of them.
Right.
And I'm grateful for that because I can't do it without them, right? But that's really what it is. You're syndicating,
Right.
and that's when you're speaking to these. They have to. They don't have to. Remember, no investor has to give you anything.
Sure.
It's more about they would like to deploy money,
Right.
and so you just got to get them in the right deal,
Got it.
something that's unique. A skyscraper, in comparison to every other market segment, has a unique insulation, let's call it, okay? Insulation in the sense of how it affects with the things that are happening in the market. Skyscrapers can't just be torn down.
Right.
The replacement cost, like the building, like the one we're in now and the other building, you can't replace them for less than 1,000 a square foot. And so you just can't do those kind of buildings anymore. And so they're protected in that way that something has to give. Someone has to help get that so that these don't become ghost cities.
Got it.
But
So
yeah.
basically, what you're saying, which is kind of interesting, that there's a layer of protection built in whenever you're going in, so your inherent risk. Because at the end of the day, any investor, when they're coming in, as long as they can understand and underwrite the risk, they're like, man, I think I'm pretty secure here.
Sure.
I mean, that's really what they're doing. They're seeking the highest rate of return, but first they're seeking security and safety.
Yeah.
And then they're looking for a return on top of that.
Correct.
Right? Okay.
Yeah. And, a lot of guys after COVID really got folded on new build.
Yeah.
Even one of our projects really, really is hurting because it's like COVID jacked up prices.
Right.
And everything has to be re-underwritten. Right. And now all of a sudden your IRRs are getting cut. And it's like, oh man, how do we make this pencil? And now it's just a vanity play. You're offsetting the risk by making it a brand, something like that. But if you're doing rehabs like what we're doing, they're a lot more secured because you already have infrastructure. You don't got to worry about having to build the whole thing before you can rent.
Right.
You can build per floor and do TCOs, temporary certificate of occupancies, get cash flow as you're moving up.
And so in that case, because these buildings are so large, there's a huge, whether you call it the city side of it, the political element, where they want to see these get occupied again. They want to see these coming back on the performance rolls, and because that's good for the city of Chicago.
Correct.
Right? Because we hear a lot of the negative side of it, but if you start letting go 10, 12, 15 of these buildings, it takes a big dampening the whole economy of the city. Is that correct?
For sure. You want to, think about how cities operate for a minute. Let's think about a macro component to this.
Sure.
Cities sell bonds.
Right.
And that's how they operate a lot of times. That's their revenue stream. They get revenue in and they're selling futures, which is the bond. And so their bonds are more valuable when more people are here.
Right.
Each person makes a city, call it, if you were to break down math, it makes them about 78 to 90 grand a year per person that they bring to the city through all the different infrastructure costs that they contribute through taxes. They sell that person as a future contract and a bond, which is why it's so important these cities get people into buildings.
Right.
And so with that said, they are very helpful in getting things done because in a way, everyone, we all want to see a thriving city. We live here, we want to see it thrive because there's more things to do and there's more people to meet, more people to see. And so this is why you're insulated.
Right. Got
right? Because the cities can't sell bonds, they can't sell any of their debt if they don't have a future to sell it on. So that's hedge fund talk now. It's macroeconomics.
So when something like this comes up, right? It's not the general public obviously is not aware of it, right? So someone like you, right? Clearly, I mean, how many buildings like these skyscrapers in Chicago?
That we have now?
No, they're totally in existence.
that are rehabable like this. In Chicago, I'd say there's, first off, not all buildings can be converted. Let's start with that.
Okay.
So even though we have 128 here, and let's say we focus on this area of the loop and things like that, the most ideal buildings that are convertible are built pre-World War II.
Okay.
One for infrastructure and light wells.
Okay.
Okay, because you can't have a unit without natural light.
Got it.
And buildings built after 1935, call it into World War II, there are boxes.
Okay.
And so all your units would only have windows on the outside.
Got it.
So when you think about it, you can pretty much count. There's really not that many. Yeah, you know, you're not talking like 40. Right. You're talking maybe 20, 30 at most if you go through, and if you do a mid-rise or you know, in terms of high-rise, we have a lot of them already. So it's like, you know, not too many that you can convert.
Got it. Yeah. And when did you come to the Chicago market?
I started coming here like right during the pandemic, 2020.
Right during COVID.
Yeah, we started working the deals in 21.
Okay.
Started closing them in late 22, 23.
Got it.
Yeah.
And so whenever you're basically selling this sort of a thing, you're going out, just for the normal person to understand, like, are you going out raising a certain amount of capital, which may be in double digits sometimes, for your down payments, putting some sort of because here, a traditional bank is not going to come in and do the financing, right? So you're going to have basically private investors that are going to do the first level of financing, right? And then by the time you stabilize it, they're going to have an exit, which is going to be pretty nice and fat, right? It's going to be pretty juicy.
Yeah.
And then by the time the whole building is stabilized, now you'll be able to do a quote unquote refi, right? Yeah. Is that the basic kind of the way the game is played?
In a way, yes. So there's about 4 levels of financing when it comes to towers, big buildings like this. And so the first level is the one that takes most of the exposure. Example, you know, everyone has to work together to make this work. We wouldn't go into this building without that plan of saying, hey, we should be doing this with this building. And so that's the first round, which is a syndication private round. I oftentimes post my own money because a bank won't finance it, and then lead that round, like your lead syndicator. And so that's round 1. Second round is your pre-dev round. Okay, this is the round that clear out some of the guys maybe in the beginning, or some of those guys flow through to the second round, right? But that pre-dev round is once you get in, you can walk around now, you can decide, all right, we got to get all of our guys in here, or MEPs, right, to start structuring it out, figuring out what can be done, plan it out. Then now you know what you can do. You can start going to the city. Now you have a plan. Now you got pre-dev raise.
Got it.
Pre-dev raise, you know, could usually in the city is going to range anywhere between $2.5 and $6 million.
Got it.
So that's like a secondary bridge.
Got it.
That bridge is going to get you to your construction loan, which then absorbs everyone else. And then some people can decide.
So it refis them out.
Yeah, because you got a construction loan.
Construction loan. So basically they have to take first position.
Correct.
Like you would in any other deal. Okay, got it.
Yep. So that's your third round.
Got it.
So that will normally clear out most of the stack. Some guys will stay on to the stabilized piece, which is your finalized loan, you know, stabilized loan. And then from there, you're just sitting on it. And in the city, when you're doing big buildings like this, there's you want to give back to the city. You know, you got to give affordable housing and things like that, so that people can come into the city and be a part of what's going on.
Got it.
And so usually the developer has to hold on to that for 7 years before they can do anything, you know, selling it.
Got it. Yeah. So are there big institutions on the backside of it that come in and pick up these buildings, or how does that work? What's the exit in the long run?
Yeah, usually it's a life company.
Okay.
Ultimately, you'd love to use life companies,
right?
Because typically life companies, they're coming in unstabilized,
right?
And they're also typically keeping you on as the manager.
Okay.
And so you're kind of able to cash a position and still maintain a management position.
Got it.
And so that's added onto the portfolio in that scenario.
Got it. So with these buildings, because these are unique, you're kind of insulated. Like we see a lot of people, traditional multifamily. When most people think about multifamily, they think about an apartment building, two, three, 400, somewhere in the suburbs, right? That's kind of the traditional multifamily, and that market has seen a lot of turmoil right now, right? A lot of people have gotten themselves into trouble, and uh, this is a very, very small market, right? Insulated market, because how many cities are you going to have quote unquote skyscrapers,
Sure.
right? So besides Chicago, is there anybody else you guys are looking to go and look at, expand? What's the next market?
Well, we're mainly focusing on skyscrapers.
Okay.
Okay, so because we've discovered that yield is there,
Okay.
And if investors can participate, it's like a very strong yields because they're not, um, they're just, especially when they're rehabs, they're
Right.
fantastic. New builds, you got to do inflow cities.
Got it.
With the exception of Austin. That one was a strong inflow city and then it kind of oversaturated. So that one has to be re-penciled a little bit. But like Miami is still a pretty strong market. They're doing some pullback, but it's still a strong market because it's a great area to be in. And so it's those markets, only skyscrapers. There is some focus on data centers. That would be the only, but only because why? I go back to what I said. It's about leverage and debt. Data centers get financed 100% up front. So the developers are getting, taken care of. They just get the property positioned for that. So those kinds of projects are really good because they're strong operators, and data centers are growing tremendously. So that's outside of that.
Sure.
But yeah, does that answer that
Yeah,
question?
no, no. I was just curious because this is a fascinating space you're in, right? I mean, no wonder your Instagram blew up, right? Because I mean, this, and we were laughing about this, that we were talking about this before we recorded, because we're like, man, how many people do you know, right, that own big buildings are actually willing to share freely? Hey, man, this is kind of the secrets of it, or whatever you want to
Sure.
call it, the behind the scene look, right? That we think about it from a house perspective, because all the same problems. I'm sure you have had people that break in. I'm sure you've had people that squat. I'm sure you go through those same things, just at a different level, right?
Yeah.
So this is not just you. I'm sure there's a huge team behind it that kind of does all the heavy lifting. It's your job to do the front end of it. Is that
Yeah,
correct?
I mean, um, you get this question all the time when you're talking to like a financer or a
Sure.
banker, and they always ask you like, "Hey, have you ever done this before?"
Yeah.
And I said, "Do I need to?"
Yeah.
Like the question is this: when you do a project of this scale,
Yeah.
you have to hire the people that know how to do it.
Right.
It's my job to make sure that that number pencils for you, and that I hired the right people to make sure it gets done. That's the question. Is like that. That's kind of a wonky question.
Right.
Like, well, now I can say, yeah, I've done it. But at the same time,
Everybody starts somewhere.
yeah, and you hiring the people,
Right.
those are the experts.
Right.
And what's more important, that I'm picking up a hammer? Are you asking me to pick up a hammer? Or are you asking me to make sure I got the numbers properly and that I gave you the right comps, and you can pencil it out yourself as a financer to see, like, does it match my math? Because if it does, then what does it matter? So you kind of have to, if I'm talking, like, that's the
Sure.
kind of the approach you have to
Right.
take. Does that answer that question?
No, no, that definitely does, because a lot of times, like whenever you think about, even when you brought it up, right, and we were laughing about this when we met for the first time, and I'm like, dude, we own a few hundred houses, right? I mean, you look at a building like this, you're like, what the hell is this, right? I mean, that's just the truth, right?
Yeah.
Even if now somebody who has a house, they may look at it and say, like, Andrew, how is that possible? You can own 300, 400, 500 houses, right? I'm like, actually, that's kind of easy, right? It's not that difficult. And the more you own, the easier it gets.
Sure.
But in your world, it's kind of the same thing, right?
Yeah.
That as you get scale, you become more and more insular, because how many people really understand your world? So, Tom, as far as hurdles, what are some of the things you run into whenever we think about something like this?
Yeah, so when you're rehabbing towers like this, infrastructure for residential is not technically there, but like if you recall what I said, buildings built prior to World War II, they have the light wells. So you got that out of the way. The runs
Yeah.
and your drainage and all that, you have to add those pieces in. But there's also a benefit with these older buildings. They typically have more elevators than you ever need. Okay, so like this building has 13 elevators. Okay, you only need 100 per 100 in code.
Okay.
Okay.
1 per 100 residents.
Yeah.
Okay.
Yeah.
Got it.
Typically, right?
Okay.
And so all of a sudden you're cutting down your elevators to 4 or 5 elevators.
Got it.
Right.
So that provides you the additional space that's
There's your
needed.
bait. There's your runs.
Got it.
See?
Okay.
So you're using those runs now to do things, trash shoot and all this stuff. So you get, that's why you do these older buildings, you get these benefits.
And so this has been an absolute joy. This has been fascinating because generally it's hard to get access to somebody that'll kind of share and say, hey man, look, you know, what is possible. And especially this is a very unique space. So thank you so much. Wish you nothing but the best, man.
Well, I really appreciate that. And look, I like to be an open book because, well, I mean, I feel that if people are given the right knowledge, yeah, they can accelerate. If I knew certain things that I did, I would be able to accelerate so much faster. And so if I can get someone to accelerate, what are they going to do when they find their first deal? They're probably going to come back to me and ask me some more questions, and I'll be like, oh, you got a deal. I didn't even know that was available.
Right.
I didn't know your uncle owned that. You know, like you never know. And so, and that's happened, right? And so you, unless you put that out there, because the truth is, I could tell literally everyone everything. Call this guy, do that.
Sure.
This is how you do this math. Here's where you're gonna get this money. And they still probably won't do it.
No, of course.
Okay, because it's too scary.
Right.
And so you just have, if you take the courage to do it, then literally it's at your fingertips. I'm literally telling you how to do it.
So I guess as we wrap it up, this would be my last question about what you said, which is fear, self-doubt, right? Being scared, I'm not sure this will work out. Am I a farce? Most normal human beings feel that.
Sure.
So the question is, what about you?
Well, the best way I like to describe that is I started with nothing. If I started with nothing, I had nothing, actually, right? My dad came over on a boat and like...
Where are they from originally?
Thailand,
Thailand,
right?
Thailand, okay.
So if they had nothing, I had nothing, okay? My dad worked in the factory. What do I have to lose? Nothing? Then what are you worried about? So, you know, that would be the main thing is you can't fear, like, what are you gonna fear? Like, what are you gonna lose, you know? I always tell people like, there's this proverb that I have in the Bible that's like Proverbs 22. Okay, every time I say proverb, people think I'm saying like Chinese proverbs, like Confucius says, "Pants is wet, go check it." You know, that's not the kind of proverb I'm talking about. I'm talking about proverbs in the Bible, and Proverbs 22 says like, you know, having a good name is important, and that favors is more valuable than silver or gold, and so when you think about that, it's like you can't be afraid, and you use your name to get you where you're going. The better your name is, the better the favors. Okay, and so if that's the way you approach things, you're going to be able to do anything because you won't have what fears do you have? If you have a good name, you're going to realize your favors are going to come your way, and you have to understand how to leverage that properly. Like there's skill sets that people have that I don't have that I look at them, man, you can really leverage that. Yeah. So they just have to recognize it. And, you know, don't be afraid if you have nothing to lose.
No, I mean, I think that was so well said because for most of us, right, we didn't start with anything. And it wasn't a very long time ago, right? And sometimes really you have to kind of say, hey, listen, as long as I'm running a good, honest business, right, things happen sometimes. Some things will work out, some things won't. But what are you afraid of, right? Because money can always be made, yet your reputation takes a lifetime to build, right? Tom, this has been a pure joy, man. Thank you so much. I appreciate it. And guys, for everybody that's listening, you're listening to Andrew Holmes, and that is Cashflow for Life. Please like, share, and definitely do not forget, it's the skyscraper guy on Instagram. Make sure you follow him. The reels are absolutely awesome. Talk to you soon.